All right, Matthew, it is all yours.
Fantastic. Well, good morning. How are you?
Well, very well.
Well, good morning, everybody. Hope everybody is well. Of course, Matthew Young. I'm the Geico local office home and auto insurance partner in the Lantern offices. As a reminder, no matter where you are in North Carolina, South Carolina, or Virginia, I write business there and probably travel there. In fact, I do travel there from the coast to the mountains and everywhere in between. And again, into South Carolina, Virginia. I wanted to talk to you guys about a couple trends that we're seeing in the market in the last few weeks and months. And over a 21-year career, I will share with you that we see more cases in the last 2 months than I have in my career, where the clients come into us and the conversation goes something like this. Hey, Matthew, I have looked through 5 or 6 different carriers. I can't find insurance. Everyone turns me down. And my philosophy, because we're a broker and we shop the market, my philosophy is, why don't we engage with your client early up front so your client doesn't get told no? Because let's be honest, if you're a consumer and you're looking to buy a home and you get turned down for insurance for 4 or 5 places, at what point do the red flags raise up and say, you know what, should I be buying this home? So my suggestion, guys, is to pick a provider who has the resources and the availability, and I'm available until 10 p.m. every day of the year, including July 4th and holidays, and work with them and promote them as an offensive measure rather than a defensive measure. Because, guys, we can bail you out all day long, but we many times are stressed when your lenders are stressed, when your clients are stressed, and when you're stressed, calling us literally the day before closing. And it sounds incredible, but it happens pretty frequently. And so I just encourage you guys to consider making the connection to somebody that you know, like, and trust, and perhaps have a partnership with, and are here to help you. And so how do you do that? It's very simple. You shoot a text introduction, and at least you have a backup option to where your client has a choice to come to if there is a problem that crops up. But I just want to hopefully get across to every agent in this group that insurance is not all the same. The rates we charge, the service we deliver, you can call an insurance company on July 4th and you're probably not going to get many answers. But again, I'm here for you and your clients every day of the year until 10 p.m. So please consider that. And again, just utilize us as a resource. That's what we're here to do, is to be there. And when you guys have questions about anything, clue reports, claims, whatever, just remember, a quick phone call can many times help avoid a lot of problems. I do know I follow you guys on social media, and many of you do a great job on that, talking about Airbnbs and short-term rentals. And just want to issue a little friendly reminder that a homeowner's insurance is not appropriate for Airbnbs by and large. So if you use your property for Airbnb full-time or even on a limited basis, your homeowner policy may fall short. So be aware of that. And also, if there's any agents on this call that own homes that are insured through homeowner policies that you do not have the water sewer backup addendum added, I just want you guys to know that when you call and report a sewer claim because it backed up and flooded your home, you may be told you don't have coverage. So if you have questions about that, call me. If you have questions about jewelry, some of you have jewelry attached to your home policy. And if you have a claim on your jewelry, you have a claim in turn on your home policy, which can result in rate increases or rate even cancellation. Be aware that, again, we write a separate standalone policy. So if you don't have any issues there, but again, I'm here, guys. Look forward to working with you. If I've not worked with you before, we have Spanish speaking staff. And again, we have many different outlets to insure. So if you do it, we likely have an outlet to insure it through many of our partners, but we don't charge any broker fee. And that's huge too, because there's been a rise in the last few years where companies have wanted to charge fees to purchase policies. And call me old school, but I don't feel like that we need to charge you a fee to do business with me. I think that the insurance premium is sufficient. So again, guys, I'm here. Please call, text, email me. I will post my information in the chat. If you don't already have it, I encourage you to hold on to it. I'm here to be a resource. And as always, Melissa, pleasure to talk to you guys this morning.
Great, Matthew. Thank you. A lot of good information.
Absolutely. Take care, guys.
All right, Terry, I'm going to make you the host. So
all right,
just 1 second here.
I might need you to give me host on both screens that I have open?
Yeah, I was just wondering about that.
Because I'm gonna try to share my screen to the Terry W. I'm working from a dual monitor setup.
Okay, well, we'll try this and see what happens. Let's see. It doesn't, I don't have an option to make Terry W host.
Let me see.
Oh,
if-
well, maybe you can because you're the host.
Yeah, let me see if I can share. Let's see what screen it's gonna share. So it says I'm host disabled participant screen sharing.
Okay, let me pull host. Let me try pulling the host back and see if it'll let me
All right.
reassign the host, but I don't know if it will because it does not show a microphone on your other.
Just put it on the Terry W, and I'll just get off my phone and I'll call in on the phone instead. Because I can call on the line on Terry W. So if you want to give the host to Terry W,
It should be over there now. Yes.
all right, let's see if we can screen share now. Yep. See if I can do it this way. I got some stuff I wanted to pull in on each screen.
I can see it.
Big screen now, right?
Mhm. Yes.
So I got a couple of screens pulled up. So guys, this is going to be very informal today. What I'm going to talk about is the 2-1 buy down. You've probably heard a lot about or seen on Facebook. We've talked to some people about it. Basically, the way the 2-1 buy down works
Hey,
is
Terry, I might interrupt for a second.
Uh-huh.
We're just looking at your desktop screen. Are you in something different?
Yeah, well, let's
Because I could
see.
hear you clicking, but I don't see anything. At least for me, I don't see anything else.
Do you see the one that's moving here?
Yes, I see them. Yeah, I see your cursor moving.
This page here? I mean,
Yeah, it looks like a shot of your desktop.
well, it's just it should be a blue screen, really, with
It's a
a
blue screen with a bunch of icons on it.
dang, I don't know. It doesn't have anything on it right now, huh? Is it the icons are at the bottom?
They're all over the place. There's two
Yeah.
little icons at the bottom, and then there's a few over to the left side of the screen and a whole cluster in the middle.
Let me just stop that and I'll reshare. Let me try to do this again. Can you see like just a plain aqua screen now?
No. I see everybody on Zoom. That's what I see.
All right. How about now? You
Yeah,
see a rate sheet? Is that what you see on there now?
yes, correct.
All right. All right, cool. So you should be able to see this too, right? Do you see this chart?
Yes.
It says markets. All right, cool. So before we get into the 2-1 buy down, I wanted to show you guys a couple of things. About 2 weeks ago, I guess, when the Fed was talking about raising the funding rate, you know, everybody kind of got in a panic. You saw buyers, you know, oh my gosh, rates are getting ready to go up. And I wanted to show you how that's played out since then. So this is one of the market guides that I subscribe to. This is Barry Habib. It's MBS Highway. And if we go back, you see here's what the 30-year 4.5% coupon has done over the course of, you know, the past couple of months. Right here where you see the cursor, June 15th, that was the day that the Fed raised the funding rate. And what you see here, this is the price of the 4.5 coupon. This is the price here. As the price goes down, the rates get worse. So when you see this chart and we're trending downwards, red is bad on the chart. So what this means is all through this time from May 27th all the way to June 14th, rates got worse. Okay. And then June 15th, the Fed talks about raising the funding rate. That's the day they raised it 75 basis points. And you can see the trend line since the 15th. You know, we've gone up pretty much every day. Green is good on the chart. Today, we're down a little bit, but from the trend that we've had, we're way better than we were on June 15th. And if I click here, you can see the price. You can see on the 15th, the 4.5 coupon opened at 98.75. It closed at 99.469. Where we are today, we're currently at 100.6. So when people talked about the Fed raising the rate, it actually had a good impact on us, because what it did is that increase was, done to offset inflation, to kind of fight inflation. Inflation is the enemy of mortgage rates right now. So this is where we like to be going. And I wanted to show you what a rate sheet looks like. I don't know if everybody on here knows what a rate sheet looks like. Let's see if I can get to it here. So here's a rate sheet. And I'm going to show you how I've kind of priced this. So if you're following my cursor, I've got this priced as a $400,000 loan with a $500,000 purchase price, a $500,000 appraised value on a purchase. We're going to waive escrows, or not waive escrows. So that means they're going to have taxes and insurance included as part of their payment. This is an 80% loan to value with a 760 credit score. Cabarrus County, 1 or 2 finance properties. It's a single family primary residence. And I'm going to choose a conforming, like a conventional loan, 30-year fixed. And I think when I show you this, the reason I'm showing is I want kind of everybody to understand how points work before we get into the buy down. So here's the 30-year Fannie Mae. So let's check that rate and see what it looks like today. And if you look here on the left, the rate is on the left. You see, we go from 4.625 down to 7.125. The next column shows your principal and interest payment. And as the rate goes up, obviously the principal and interest increases. This is a 30-day lock. Here's your final lock price. And then this is the points that you would pay. So when a lender talks about a buy down, you're looking at typically paying a 1-point origination fee. And the way I explain it to people, it's basically a buy down fee. If we go into the store and buy something that's $99, we're talking basis points here. So a lender has to have 100 basis points for their final lock price. So when we talk about pricing, par pricing is 100. That's where every lender wants to be. And what's so screwed up about rates right now is typically the lock price will go up as the rate goes up. But you can look and see in here a couple of places. There's some places where the rate goes down to go to a higher rate. So it doesn't make sense why the price would go down and the rate would be higher. So you can see we're at 98.963, 98.993, 99.4, and 99. So you would actually pay more points to get to a higher rate if you went 5.75, which doesn't make any sense. Usually the points are the buy down. So the screwed up part with rates right now is there's not a lot of concessions that are in here. We can do premium pricing and give credits for closing costs, but you can see there's not a lot of credits in here until you get down here. Once you get over 100, the borrower gets the difference back as closing costs. So if you look at 6.125, 100.189, the borrower would actually get $756 at closing there if they chose that rate. Whereas if we went to 5.625, you can see it's 99.423. They would actually bring $2,300. So when you hear people talk about buying down, there is a permanent buy down and there's a temporary buy down. Well, the permanent buy down, I've seen some lenders use that recently. To get better rates, I've seen lenders that have charged 2 and 3 points to get to a better rate. And I don't like doing that right now, because the reason what we all are thinking is that rates are going to continue, at some point to get better again. We think Inflation is the kicker right now that's keeping the rates higher. And what'll happen is once the Fed gets inflation under control, then they're going to end up, the market will come back. We don't think we're going to see 2s and 3s, who knows? We should see 4s again, we hope. And all this will probably happen the first part of next year. I wanted to go back and show you again on the market update here. What I've been following mostly to kind of track rates is the 10-year treasury. If we go back to this chart, let's go back to June 15th again. So June 15th, this was the day that the Fed raised the funding rate. And you can see the price at 3.44 on the 10-year treasury. That was the day that the rates were at their highest. Since then, they've started to come back down. We're at 2.86 right now. As the 10-year treasury drops, the mortgage rate should go with them. So if you have people that want an indicator on what to watch to kind of track the rates, the 10-year treasury is the best thing. Because as this goes, and they think it's probably going to drop even down into the 2.6, 2.4 range again at some point, the rates will continue to drop with it. Now, the one thing that's kind of uncertain is we have to watch inflation. And the analysts that I subscribe to feel like inflation's going to peak about October. It ticked back a little bit. If you look back to last week, Thursday was a day where there was an inflation report. Let's see, was that the 29th, I think, or the 30th? You can see we got a big jump from the 30th to the 1st. There was an inflation report that was released on the 30th that was inflation was lower than expected. So we got a big boost here. So what we think is that once inflation kind of peaks, maybe October, we should see rates start to drop, probably, especially first quarter next year. The reason I say this is we're going to end up probably refinancing all of these loans this year. We'll probably end up getting refinanced next year. So you have to look for short-term solutions to borrowers to help them get into situations where they can afford the payment, and also look for a better rate right now. And that's where the 2-1 buy down comes in. The way the buy down works, if we were to look today, so let's say the rate, if we went to a par rate of 100, the rate is at 6.125. The way the buy down works is for the first year, the borrower can get a rate that's 2 points better. That's the 2 and the 2-1 buy down. For the second year, they get a rate that's 1 point better. Well, if you were to look at a rate sheet today, you can't even get a rate that's 2 points better than 6.125 by paying points. To get a rate at 4.625, a borrower would have to pay 3.8 points, which is $15,000 on, towards closing. This would be a permanent buy down. If they paid the 3.8, they would get the rate at 4.625 for the 30-year fixed rate period. We can't even charge 3.8 points. The most we can probably charge and not have a high cost loan is probably somewhere around 2.5. So the way the buy down works is they would take the 6.125, but for the first year, they would actually have a rate of 4.125. For the second year, they'd actually have a rate of 5.125. And here's how that kind of works. Did everybody see this okay? So if you look at how the buy down works, if you take a $650,000 purchase price, this would be like a $617,500 loan amount. With 5% down and a 6.5% rate, the principal and interest is $3,903. For year one, the rate would be at 4.5%. Principal and interest there is $3,128.78. So if you take the 3,903 and subtract the 3,128, you're saving $774.24 a month for 12 months, which is a total of $9,290.88. This amount is put in a subsidy for year one. For year two, the difference in payment, you can see 3903 to 3506 is $396.92. That is $4,763 savings for year two. The subsidy amount would be this $92.90 plus the $47.63 for a total of $14,053. The way this works is this works best when the seller pays the subsidy. So if you have people that are looking at a price reduction on a home, instead of reducing the price from a $650,000 purchase price, we would take the $15,000 in the form of the subsidy at $14,053.92. Basically what happens is the subsidy account sits there and it's like an escrow account. For the first year, with the first payment, $774.24 would come out of that account and go to pay the difference between the two mortgage payments. Second month, another $774.24 comes out, pays the difference. So that's what's giving the buyer the difference in the rate for that period of time. What I like about this is this amount of $14,053 is sitting in an escrow account. Instead of doing a buy down and paying 2 points to get a rate that's better, once you do the buy down on it with, paying the points to get the lower rate, that money's spent. When you go to refinance that loan, the points you paid on the rate is gone. That money's no longer there. It went to that first loan. If we were to refinance this buy down loan this way, any money that's left in this subsidy account, this escrow account, goes to pay down the principal on the new loan. So when you go to refinance, you're not losing this money. You're actually getting credit for it towards the principal payment on the buy down on the new loan when we go to refinance it. And I think this is very confusing. It's hard to follow, but does everybody see where the money's coming from in the buy down? You have two options when you go to do a buy down on a rate. You can buy it down permanently by paying points up front, or you can buy it down temporarily by doing it in a situation like this. And it would make more sense to look at this option because this money here, you're going to get back in the form of a principal reduction when you go to refinance it later. And what it does is it gives the buyer gets a rate that's 2 points better for the first year and 1 point better for the second year. And more than likely what's going to happen is we're probably going to be refinancing their loan somewhere in this period of time anyway. So they would get this money back towards the principal reduction. We'd refinance the loan, get the better rate next year, but also get a better rate this year, with the 2 point reduction in the rate. The 2-1 buy down means that the first year you're going to get a 2 point better rate. The second year you're going to get a 1 point better rate. Does anybody have any questions? I mean, I know it's very confusing on how it works.
I do, Terry. This is Sherry.
Okay. Hey, Sherry.
Hey, so I was trying to follow along here, and I may be the only one that didn't, or that I may have missed something. But so if they're only paying that lower amount, say in year one, the $31,2878, and you said the excess would go into a subsidy, it would be, in an escrow as a subsidy amount. Where does that excess come from? I mean,
so the excess in this case would be coming from the seller. The buy down works best when the funds come from the seller. So the situation to look for this would be in a seller who has, their house has been on the market for 20 or 30 days, and you're looking at doing a price reduction on the listing. Rather than doing the price reduction on the listing, we can add verbiage to the listing, that basically says the seller would be interested in working with a buyer on a buy down. You can say stuff like, talk to my preferred lender on how to get a much better rate, for the first 2 years. And instead of doing the price reduction on the house, you would offer the subsidy.
Okay, so the purchase price then would still be that higher amount.
Say that there was
But the,
higher amount. Yeah, the purchase
but the
price.
seller would be agreeing to allowing this subsidy amount, in this case, the 15,000 to be held in escrow.
Mhm. That's right.
Okay.
Yeah.
Okay, thank you.
The hard part is understanding where the savings comes from. With loans, we have we can only go to 3 points on any deal. And when you look at 3 points, if we're saving on a $650,000 purchase price, points wise, here we've already got just about 2 between this, maybe a little bit more. This is 14,000. 2 points on 650,000 would be 13,000. So we're a little over 2 points. So we can't charge this to the buyer. The buyer in some situations could pay this, and it makes sense because they're going to get a better rate for the first 2 years. The problem comes on the lending side. We can't charge more than about 2.5 points, and we've got a little over 2 here already. Now, seller concessions on a 5% down, the seller can give up to 3%. So we're a little over 2 here. So if we did this 650 purchase price, the seller could give this amount here, the 9,200 and the 4,700, and allow the buyer to do the buy down. And then from y'all's perspective, it keeps the purchase price a little bit higher, which is going to help comps going forward. It's going to help as far as commission, and it probably will help as far as net equity to the seller, because the typical price reductions I see on like a 650 aren't usually like, 5 or 10,000. They're usually like 20 or 30,000. So it just depends on where you're at as far as, how long it's been on the market, what kind of price reduction you're looking at. My personal belief is that buyers don't care as much about the price as they do the payment. They want to know, what's my payment? Am I comfortable with that versus what's the price of the house I'm paying? It's usually payment and cash to close. And this helps with the payment for the first 2 years on it. And like I said, ultimately what we think is going to happen is we're probably going to end up refinancing all of these loans. So if you can get them to a situation where they're comfortable for the payment the first 2 years, then it may give them an option to get into a refinance loan at a better rate later.
Terry, would this just be simply called seller paid closing costs, or would there have to be pretty elaborate discussion with the seller for them to agree to this and understand the escrow account and the subsidy and all of that? I mean, I'm just trying to think of simplistic terms, but yet still meet lending guidelines.
Right. Yeah. Yeah.
Are these considered seller paid closing costs?
So it's a seller concession is what it is. So yeah, you could show it as the closing cost that way. And then we would just be using it towards the subsidy. So
I'm thinking in our offer to purchase contract where we ask for the seller concession.
There's no place for you guys to list it any differently in there, because I'm trying to think back to the contract. You wouldn't have anything where you would list anything like this other than in that section right there where the closing costs come into play.
Right. That's what I was thinking.
I'm trying to think, are there any addendums that y'all have that would address any other way? I'll find out the answer to that question to see. There may be an addendum that would come into play to show it being used in a different way other than closing costs. Because I'm trying to think on the CD, we would be showing the escrow account set up to hold the subsidy amount.
Okay, thank you.
Yeah, let me find out more information on that with where it's going to show up on the CD. And I'll see if there's an addendum that's in play on that too. This was a program that was used probably prior to 2009, and it was used a lot by builders to help borrowers get lower payments for the first couple of years, but to keep sales prices higher. Obviously hadn't been used for the last 10, 12 years because rates have been super low anyway, and nobody had to look at anything to get rates any lower. It could have been used, but there was no need for it. Obviously the reason it's coming back out of the woodworks now is to get rates a little bit lower for buyers. You can look at it a bunch of different ways. People, when they're buying a house, have other costs associated. They have funds going to different things to get the house decorated, to set up, services and all. The lower payment for the first year would help them, start to eliminate any other costs they have, car payments and stuff like that. If they have a 2 years left on a car payment, this would save them money for the first 2 years. The car payment pays off. Worst case, if they went back to the 6.5% rate the third year, hopefully those debts are out of the way at that point. The way I look at it, there's a couple things that can happen with rates. Rates get better, and we refinance during the time when they're at 4.5 or 5.5. Rates get worse, and at worst, they're going back to a 6.5% rate, in year 3. So it can save them in a couple of ways. It gives them a worst case scenario, but gives them a chance to do better the first 2 years. So I think it's more of a benefit to the buyer, obviously, because of the rate reduction and the payment changes. But from the sell side, rather than dropping the price, they may be able to generate a little more equity out of the property. Let's see what's on here. So from the realtor perspective, it's another way to differentiate yourself by using a strategy when including this in your listing presentations. You can offer this option rather than price reductions on listings remaining on the market longer. And it allows for higher purchase prices, obviously with higher commissions, decreased impact to appraisals values in the neighborhood going forward. And we have seen stuff setting on the market a little bit longer. So we know that, there are some price reductions out there. From the seller perspective, less impact to the net proceeds, increased buyer pool due to the comfort level with a lower payment. That's been probably the biggest complaint that I've heard, with rates going up, is the payment. And if there's anything we can do to get that payment a little bit lower, then we got a better chance to get some deals out of it. And it offers opportunity to the first-time home buyers, again, for the cost. A lot of times first-time home buyers don't have the DTI is a little bit higher, and it helps them get the payment a little bit lower while we're in a period with a higher rate. From a buyer perspective, it's a more affordable payment for the first few years. It offsets expenses associated with a new home ownership. Future increase to income will allow payments to become more comfortable over time, and a possible option for future refinancing because of the remaining Buydown funds being able to use to offset that. They're going to pay down that principal balance on that loan. So it's an option that if you have listings out there that you want to be able to offer this before you drop the price, it's a good thing to look at. Let me see if I can find this. This is an easy way for you to calculate the buy down also. This is a calculator that we kind of came up with. So let's say you got a $300,000 loan amount, and we're using the 30-year fixed with a 2-1 buy down. And let's say the interest rate's 5.5%. The total subsidy on this loan for $300,000 with 5.5, the total subsidy would be $6,474. And you can see the difference. Year 1, the payment would be $1,347. This is principal and interest. Year 2 would be $1,520, and year 3, the $1,703. So this would actually be your payment if you took a 5.5% rate at $300,000 for 30 years. Your payment would be $1,703, principal and interest. But what the buy down does is for the first year, it gives you a principal and interest payment of $1,347. And for year two, it gives you a payment of $1,520. And then this is what the subsidy would be coming from the seller. You would have the $64.74 coming from the seller to pay down the buy down for the buyer. And then of course, as you go higher with the loan amount, obviously the subsidy is going to increase and the payment differences become a little bigger. So it can benefit pretty much any buyer, any loan amount. But it's a little bit complicated. It's hard to explain how it works. Does anybody have any questions on how it works? If you have questions and you want me to come and sit down with you, one-on-one, or if you have listings that you've got that you're looking at doing price reductions on, we can look at how to set up the program, to help the buyers, maybe help your seller keep the price a little bit higher. And then, keep sales up a little bit on this with a pretty big buyer benefit on it. Everybody kind of stunned on. All right. Well, if nobody has any questions, thank you guys. Feel free to reach out anytime on it.
Terry, thank you for that. I think that helps people understand a little bit better what it is.
Yeah, so to try to put it into words, it basically benefits the buyer by getting a rate that's 2% better the first year and 1% better year two. And it can help keep the prices of the houses higher, because instead of dropping the price, do a price reduction, giving more seller pays, you're doing the subsidy for them to get the better rate out of it.
Right. Well, I mean, it sounds like it's going to work for a lot of people. So.
Yep. I think it will. And like I said, rates have gotten a lot better over the last week or so. So hopefully it's something that we don't have to even talk about a whole lot. If we can get rates back in the fours, people are more comfortable. The ARM rates right now are becoming more attractive. I liked a couple of ARM rates this week at 4.75 on a 5-year ARM. So there's some information, some rates and stuff there that we can all live with that.
Right. It's good to have options though.
That's right. Yeah, absolutely. Well, thank you guys. Like I said, let me know if you have any questions. Feel free to reach out anytime.
Perfect. Thank you so much for taking the time to help us.
You guys take care. Have a good day.
Thank you, Dan.